Welcome back, traders. Welcome to lesson 10. My name is Stefan Tron, and in this final lesson of the course, we will be discussing diagonals and strategy. Guys, if you want to have access to yearly charts, I just quickly want to show you this as well. You guys can always go to this. The website's name is fxtop.com. Then say, for instance, you want access to the, let's say, USD CAD. Let me just get that on the screen for you. Where's the United States dollar? For example, here we have the USD CAD yearly chart. So as you can see here, we've got the yearly chart. So let's just quickly look at it. So here we had this move up. Even on the yearly, the wave, you'll see the wave patterns and the structures. And then what we know now is basically that this is the highest top and this is the lowest top. So everything inside here will be classified as a correction. And as you can see, we've got a 1, 2, 3 move, and chances are that we can get something like this, go back up again, maybe come back down, or it will form something like this, go back up and come back down. So as you can see, this is a great site if you really want to go into all the charts, what happened in the history from, like this chart is from 1953. So you've got quite a lot of charts. I wish we had the MACD on here, but unfortunately we don't have the MACD on here. Okay, so let's go quickly. We're quickly going to touch on diagonals, and then we are going to go into the strategy, basically how we would get into the trades, the strategies we use to actually get into the trades. So guys, in diagonals and leading diagonals, diagonals and leading diagonals, chances are that you will get continuous divergence on your MACD is very high. So that is one of the key things that it tells us that, hey, we're actually looking at a diagonal here. In this case, it was an ending diagonal. And please remember, guys, in the ending diagonal, we will start to label this as A, B, C, and then if you get after the C move, if you still continue down, you must already start to think that, okay, we got another move down after the ABC. Chances are we might be forming an ending diagonal, and that is actually the case what happens. And please remember, diagonals we label 1, 2, 3, 4, 5, and then normally after the 5th move, you'll reverse. So this is basically the only time when you can see ABC, but you would end up getting another move down. So if that happens, then you can really start to think that, okay, we might be forming ending diagonal or a normal diagonal, or sometimes even an ABC squeeze. So this is a good example. Say we had this move down, and then we had this little correction over here, contracting flat. I hope you guys know your patterns by now, and you can tell me immediately what patterns we are looking at. So then we made this another move down. So now we have divergence, and now we would have labeled this basically A, B, C, and after this, we would expect the market to reverse or make another big correction, but it made another correction over here, and then we went down again. So once that happens, we will take off the ABC and we will think to ourselves, okay, we might be forming an ending diagonal or a diagonal. In this case, it was an ending diagonal. So then, this will be 1, 2, 3, 4, 5, and then now we can expect a reversal, and that's what happened. So guys, please remember, when you first get an ABC, always have in the back of your mind that you could be forming a sum diagonal or even an ABC squeeze. So here we have another example of an ending diagonal, and like you had this move up, you made your another move down, and now you're expecting it to reverse. Excuse me. Now you're expecting it to reverse, but it doesn't, and you're seeing continuous divergence on your MACD. So now you can already say, okay, we're probably forming the ending diagonal. So there we had 1, 2, 3, 4, 5, and then actually, we reversed after that. Okay, guys, let's go into the strategy. So basically, we have 3 strategies that you can use. We've got one that's, in my eyes, it's probably the safest strategies, and it's very good for beginners that's just starting out to use this theory of ours. And then we've got what we call a fib trade, the 618 trade, and then we have our aggressive strategy is more for advanced traders. I don't recommend the aggressive strategy if you guys are just starting out. But as you get more experience, you can try it out. And then our strategies are basically designed for one thing, and that is to catch the next impulse. And that is actually what we want as traders, is to always catch that next impulse. So let's quickly go into the strategy. So let's say you got a first impulse, right? The chances of you catching this first impulse is very, very unlikely. Then you will get your free wave correction. So looking like this. And then you can pull your pattern lines over here. And then our strategy is to buy the breakout. So let it prove to us that the correction is over, We want to see confirmation that this correction is actually over and it is going. So then this will come up here, and once it breaks out of this correction over here, what we want to see, let's say this is a 1 hour time frame. What we want to see is it break out, and what I mean a breakout, we want to see a solid candle close outside of this correction. But we will go into the chart and I'll show you some examples. And then after we've broken out, we want to maybe see a little flag over here, just to give us confirmation that okay, that is basically going. So what is a little flag? And some traders get very confused what a flag is. I mean, a flag, this is a correction. Don't get confused between a correction and a flag. A flag is basically, a very small sideways move like this, and then it will break out. So what I mean by a flag is you maybe in the 15 minutes you'll get 3 to 6 sideways candles like this, and then when it breaks out there, we've got our confirmation to get into the trade and trade this next move up. But we will go into the charts and I'll show you some few examples. Then the other thing you can also do is on your higher time frames, maybe your 4 hour and your daily time frames. Let me clear this up. So let's say you've got this move up, and now you're going to form the correction, right? So remember, this is 4 hour. Then you'll get your first move, then you'll get your B move, and when it comes down here, and it normally crosses this this low, what you can do then is, sorry, let me pull that correct. You don't have to wait for this breakout on the 4 hour. You can do that as well, but what you can also do is, if you get a 1 hour impulse with a correction over here, you can already get into the trade inside this 4 hour correction, and then if you write about the trade, you will get something like this. If you manage to miss this, no worries, just wait for the breakout, and then on your 4 hour you want to see a solid candle close with at least 3 1 hour side candles, so a little 1 hour flag. So let me make this clear as well, guys. In a 1 hour correction, you've got this, you got this breakout, right? In a 1 hour correction, you want to see a breakout and at least 5 15-minute sideways candles for it to prove to you that it's going to break out. In a 4 hour correction, let's say this is a 4 hour correction, you'll see your move like this, and then your B wave in the middle, and then we break out here, right? In this breakout, after this breakout, we want to see at least 3 1 hour sideways candles to make the flag for us to go. And then in your daily, say this is a daily correction, you get this, you get your breakouts, right? Solid candle close for your breakout. And then your daily, you want to see at least 4 hour sideways candles to take this trade to the upside. So just remember that. Don't go and try and take, but for example, you've got a breakout on a daily, then you wait for 3 15-minute candles. That's not going to work, guys. So the other thing I also want to touch base on, let's say for example you have this 1 hour, let's say it's a 1 hour breakout, right? Then you break out, and now you get your 3 15-minute sideways candles, and now let's make this the 15 minutes a different color. So there's your 3 15 minutes, and now you're ready to go. Then let's make this yellow again. You take the trade, but this on the 1 hour now. On the 1 hour, you get maybe 1, 2, 3, 4, 5, 6 sideways candles, and it doesn't go anywhere. That's not what we want, guys. When we take the trade, it has to go. When it breaks the stop, it has to, impulse is explosive, it's impulsive. And this basically tells us it might not go. So what we do then is take off the trade, try and get out for break even, and then you wait. If it breaks out of here, then you can enter the trade again. So, if you see, if you take the trade and it's not going anywhere, it's best just to take off the trade and wait for your next entry. Because sometimes if this happens, this can happen. Then what ends up happening is you get in a bigger correction, and then only you can expect something to happen like this. And then another thing that you can do is, let's say you got your breakouts trade, there's your breakout trade, and you check it, and great, this trade starts to go. Oh, by the way, our stop losses we will put below the correction. You will put your stop losses below the correction. So in any case, you take this trade and it starts going nice, and then what you can do is, and this is a valuable lesson, guys, listen to me. Once this happens and it starts to go, What you will do then is you will move your stop loss to break even or just above where you took the trade, just to maybe cover your costs, your commission and your swap costs. This is very valuable because what this means is we actually got a risk-free trade. So if there's, for whatever reason, something happens and it reverses and it comes back down very quickly, maybe we form in expanding flat, then you won't lose anything on this trade. But if it hits our profit target, great. So, but what I normally do is when the trade starts to go, move your stop loss to break even. It protects you a lot. You will be surprised how this will protect you. And guys, please, like I said, the lowest entries I take is on the 1 hour time frame. So I take 1 hour breakout corrections. The only reason what I explained to you is maybe at extreme levels, and extreme levels is only maybe daily charts or sometimes even 4 hour charts. It depends how big the correction is. Then what you will find a lot of traders, and I see this with newbies, is they get into trades, they get into the trades way too easy, because so maybe get something like this, and then they will pull their trend line like this, and then when this breaks, they'll get into the trade. But they neglect to notice that this is not the whole correction. I mean, that's only the first wave. This is a fully developed correction. So you have 1, 2, 3 pieces. You have 3 waves inside this correction, and now only will it be correct. So if you find this problem, we came up with a pretty genius way for traders to help them in this regard. What you will do is you will pull a box. You will box the impulse, right? And then what you will do is you will move this box to over here, to this side. So then you will force yourself, you do not touch this trade until it's broken out of that box. That means, the correction had enough time to form, and now only you can get into the trade to go. So if you find at the beginning that you're getting into the trades too soon, you're battling with your corrections, what you can do is you can pull your box, move it across, and then you can wait for it to complete the box and then enter the trades. And then a very good thing you guys can also do is when you take a trade, before you take a trade, let's say you have this 1 hour correction over here, and you take this trade. Before you take a trade, let's say this is a 1 hour, go to one higher time frame and look at the bigger picture. You always have to know what the bigger picture is. So let's say, for example, you take this trade and now you're expecting it to go there. But what you neglected to see is that this is actually, on the bigger picture, you will actually just maybe go to here, form this 4 hour regular flat, and then you reverse down for your bigger movement that will be down. So it's always valuable before you take any trade, just to go to a higher time frame and see what the bigger picture is telling you. I've seen a lot of traders that they try and take every 1 hour setup they get, but they neglect to look what the higher time frame is. Your safest bet will be to always trade in the direction of the higher time frame. So let's say you complete this 4 hour correction, and now you get a reversal, and now maybe on the 1 hour you can take this for this breakout down impulse. So it's pretty simple, guys. So let's go into the charts and just show you how you will go about it in the charts. So, okay, let's go to 1 hour. So basically, let's start here. So here you had this expanding flat, right? Now what you want to see is you want to see it break out. So in the expanding flat is especially expanding flat and a running flat, the safest bet will be wait for it to break the top and then enter the trade. If you're more experienced, you could have entered the trade over here, because I can already see that this correction is complete. But so what you would have done is, there you can see you had like a little flag over here, and on the 15-minute you will probably spot that it was a little flag. So let's go to the 15-minute there and see how it looked there. So here we are on the 15-minute, and you can see that we broke this top, and here look at here's this is a 15-minute flag, and then when it broke out here, you could have taken the trade to the upside. So look, you can even see here, I mean, this was clear as day. This correction, you had your first move, and then you had your second move, and here was your B wave. So this is pretty easy if you experience to spot that, okay, this correction is over, and you could have taken this breakout. So let's look at some more examples. Let's look at maybe recent examples. So say before you entered this trade, you would have maybe, let's just go one higher. And here, okay, so this is a pretty huge correction, and it does have space to move to the upside. So trading it to the upside, you could have done this in this scenario. I mean, this wasn't a complete move. There's another thing I want to discuss with you, and you'll hear a lot of people on the internet say this, but I actually came up with this name for this pattern. Is if you get a proper flat and you break out and it doesn't go and it comes back, what I call this is the fool me flat. So what you will notice about a fool me flat is it will break out, but it won't go. A fool me flat usually means that it's making a bigger correction. So here it made one piece, there it made another piece, broke down, and then here was your third piece. So now you're looking at this as your whole correction. And only here, there on the 1 hour, you could have maybe traded this up, come back. You would have put in your stop to your stop loss would have gone here. You would have moved it to break even. It would have taken you out for break even, and then you had this, and then this you could have traded to the top side, because your this bigger correction isn't complete. We only have one sharp move, right? So we're expecting another sharp move, and that's what happened. There you had your other sharp move, and this was your B wave in the middle. So this trade up you could have taken. So on this 1 hour setup here, we would have gone to the 4 hour, and you would have seen, okay, there is some move to move, some space to move to the upside, and you would have taken it. So let's go to this last piece, and this is a trade we're actually currently in. So over here, let's say we had our trend line, and on the bigger time frame, you do have divergence on the 4 hour. And here we made this reversal. This is another thing I want to quickly go into. This was probably a news event, this candle over here. Most of the time when you see big candles like this, it is news driven. So the way we trade news is we look before the news happens, and let's say this 1 hour, this big candle didn't exist yet, and before news we had this structure telling us that let's trade it down. So what we will do then in the news, just before the news, we will go and place a sell stop maybe just outside here. And then when the news happens and this shoots down, we will move this trade to break even as quick as possible. And then, we did that, and there you had your next correction, and you could have continued. Let's pull that properly. So basically this was an expanding flat, and here we broke the top. And there we had a little flag there, and you could have gotten in there. And now it's forming another correction that could go down. So let's just go to a 15-minute and see how this looks on the 15-minute. So you had your solid candle close, right? And then let's go to a 15-minute. No, man, don't do that. So basically on the 15-minute we had this, and we could have traded this down. That would have been our entry. So what we want to, let me get some space to draw. Let's say you have your correction right there, and then here it broke out. Let's say the candles look something like this. I'm not drawing proper candles. So let's say this candle was a big candle and it broke. We had a solid close outside of this correction. What you want to, why do we wait for confirmation? Basically, you want to see your free 15-minute sideways candles, right? The little flag. Why we do is we want to see that the market doesn't retrace this candle that actually broke out. If the market retraces this candle with, let's say, 60-70%, it's very risky, because the chances are that it will do this, form a fool-me flat, and make a bigger correction is high. So that's why we want to see a solid candle close your sideways. We don't want to reverse this candle. I hope that's clear. So let's go to maybe another chart, and let's see the previous entries on another chart. Let's maybe start now at the higher time frames. So basically, oh, that's a bit too high. Let's go to the daily. So let's go to where the stop starts, maybe. And this can also work. And I just want to show you how we would have traded the higher time frames. So here's a daily, so we had an impulse move, and here we had a daily correction, and then here it actually broke out. So when we started to form this, we could have gone to a 4 hour. So let's go to a 4 hour. So this is a daily setup. So basically we had this impulse up, and then on a daily we had this setup, and then we actually broke out there. So let's go to a 4 hour and see how we could have traded that. So let's just mark it here so we can find it on the 4 hour, and then let's start where it actually started. There, that's okay. Let's go to the 4 hour. And basically, here we are on the 4 hour. So then you could have, let's just mark this. You had this little correction over here, a 4 hour correction, and we're expecting the breakout of we're expecting that this little correction, 4 hour correction, will break out of the daily, and that's actually what did. So what you could have done then is, I'm just going to show you, there you got in your breakout, and I'm pretty sure when you go to a 1 hour, you had clear confirmation. So on a 1 hour, that would have been a little flag. So there was your confirmation to enter the trade, and then this trade actually went very well to the top side. So let's see, let's go to the 1 hour and see the and see if there was any recent. Here's a good one. So recently we had this move. That was an entry order. So sometimes if you're not in front of the charts and you get like your expanding flats and even your running flats, what you can do is you can put a buy stop order here. So when you're not in front of the charts, that you can actually catch this trade to the top side. But okay, so we broke the top, and now we want basically confirmation that this trade is going to go. So let's go to 15 minutes and see what we actually saw there on the 15 minutes. So there, on your 15 minutes, you had this little flag over here. And when it broke out of here, you had clear confirmation that, okay, you can take the trade, it's not going to reverse, and then you could have taken the trade. Let's go back to 1 hour. So remember, guys, your stop loss will go underneath this correction. So there would be your stop loss. Other thing, guys, that's just how I do it. You can do it. You can decide on your own what you want it to be. But my risk to reward, so my RR, I don't take a trade if my reward isn't at least 1.5 or above. So what do I mean by that is, let's say, for example, let's take this small impulse move here. Let's fib it. So we know that our profit target, we are going to be trading majority of the time to the 27%. So now you can take your little long position tool over here that you have on TradingView, and then you can go and measure it. So our stop loss will go there, and our profit target there. So now this is going to tell you your risk to reward is only 6.5. So you're risking a lot for so little gain. So this isn't really worth it. So let's go maybe to the higher time frame. And let's try and find maybe a trade that came from up here. Just want to show you guys what is a good risk to reward trade. Okay, so let's say we had this expanding flat, right? And okay, so your stop loss on this trade will go there below the correction, right? And then I probably would have entered this trade inside here on the 4 hour. Oh, sorry, on the 1 hour. So there was a little 1 hour flag there. I would have entered the trade there. So let's go to our long position, and let's first pull our fib. So then I will pull my fib. The profit target is here by the 27, right? Always going to calculate our profit target to the 27. So now I'm going to take this long position and see if this trade is actually worth it. That's just how I do it. You guys can always do it differently, you know. But I found that this, this builds my account. So risk rewards 0.94. So, but it's not even a 1-to-1. So once again, not a very good risk reward, right? So maybe I will skip this trade. Let's try and find. I'm just trying to find a trade that's basically will give you a good risk reward. So let's go and see if we can find one in the past that actually happens. See where this downtrend actually starts. Okay, so basically this downtrend starts over here. So we had this down impulse move, and now we had this correction over here, right? So now our stop loss will go above the correction. So let's say the stop loss goes there. Okay. Now we're going to pull our fib. We're going to flip the impulse. I'll pull that now properly now. There. Let's just get to the top. Here we go. Okay. So now I enter the trade here, right? Wrong one. I want the short one, not the long one. So I'm going to delete that now. So this trade will have given us 1.27 risk to reward. Okay, maybe almost 1.5. Maybe I would have considered this trade. Okay, let me go and find some more examples just to give you the hand of what I actually look for regarding risk to reward when I take a trade. So this is basically a very good example of a good risk to reward trade. So we had this impulse move up, and then we had this correction over here. We had a breakout of the correction, and then this is a daily, guys. If you go to a 4-hour, you would have had a proper 4-hour flag over there, and basically I entered the trade there and traded it up to the 27. So if you look on your risk to rewards, on this trade was basically 2.82, so almost free. So that's a good example of a good risk to reward trade. So basically the second strategy that we use is, let's say you get an impulse like this, you get your correction over here, and you break out. You form the next impulse move, and then you make another correction like this. So what we will do is we will pull our fib from here. We will fib this impulse move, and this is key with this fib trade is on these two impulses over here. There must be no divergence on your MACD. So what that basically means is if there's no divergence, we're expecting another move to the top side. So what we will do is we will fib this impulse move, and then we will put a buy limit order at the 61.8 retracement. So there we will buy right there, and our stop loss will go underneath here, and then we will trade this to the 2.7. As you can see, this is also a very good risk to reward trade. So that is basically the FIB trade. So the rules is it has to come back to your 618. That's your first rule. Second rule, no divergence, and in this third rule, you can make in this correction over here, make sure you at least get 3 waves down. And we put fourth rule is we put our stop loss underneath this this impulse over here, and then so you also pull a trend line like this, guys, and if this tags your trade, but it breaks the trend line and it forms a little impulse, a little correction like this, it looks like it's going to break down, we get out of the trade. So that is basically your 5 rules for your FIB trade. Now I'm going to find some examples for you in the charts, and then we will look how they look. So here's a good example of the FIB trade. So we had this first impulse move up, then we formed this correction and we made the next impulse move. If we look here on the MACD, no divergence, so this fits the criteria. So we would have put in a buy limit order right there, and our stop loss would have gone here, and we would have traded to the 27% target. So as you can see, it to the dot, it hit the 618 retracement, and then it actually went up all the way to the 27%. So let's put that into perspective for you. So there would have been our buy, and our stop loss would have gone over here at the bottom, just below there, and we would have traded this to the 27. So a very good risk reward to 2.1. So this is a good example of the FIB trade. Okay, and then the last strategy we have is, but this is a very aggressive strategy if you're an aggressive trader, and it is riskier, more riskier than our previous other 2 strategies we do have. So, and we will only use this strategy on a 4-hour or a daily. So basically what the guys will do is you have your daily 4-hour impulse, and then you will form your first wave and then come up for your second wave, and then you will pull a line here at the bottom of this correction. And what they will do is, if this comes back down here and there is divergence on your MACD between these 2 spots over here, they will buy the trade right there, and then their stop loss, they will FIB this first impulse to the 27, and they'll put their stop loss over there, and then they will trade this up to the 27% target. So the rule is you have to have divergence when you get to this spot to be able to do this. If you don't have divergence, don't do this. But this is a pretty risky trade. But no, this is for seasoned traders, and as you can see, your risk to reward is exceptional good. Sometimes you get a risk to reward of 8 to 1, 7 to 1, and we'll go and look at some examples in the charts. Okay, so this is a good example of the aggressive strategy. So you had this impulse move down, then you had your first move right, then you formed your B wave, and then when this came up here, you'll see that there was divergence on this, slight divergence, and then the traders would have put in a sell limit. They would have sold it right there, and if you let's see where their stop loss would have gone. So they will take the Fibonacci, they'll flip this A move of the correction, and then your stop loss will go here by the 27. So let's just mark that stop loss. Now what is it doing now? Just hold on. Okay, let's mark the stop loss over here. Basically there's our stop loss, and we can remove, we can actually just flip this away because we want our profit target. Flip this around, and our profit target is here by the 27. So now look at this risk to reward, guys. It is quite amazing when these trades work. So if you're not, if you want to just test out these trades, it will be, good example. If you maybe just take, let's say we're going to talk about money management rules now. That's the next thing we're going to talk about. But let's say, for example, you only normally trade 1%. What you can do with these aggressive, riskier trades, you can just maybe trade half the size you would have always traded. And as you can see, this risk to reward was 5-1. So very good risk to reward that you get on these aggressive, strategy. But they are risky. Sometimes it just wipes through your where you buy, and it just goes straight to the profit, to your stop loss, and turns around. But when they work phenomenally good. So had you risked 1% on this trade, you would have gained 5% on your account. Okay, and then I just want to quickly go into another strategy that if you are familiar with options, this strategy will blow your freaking mind. So basically, and we will only do this on a 4-hour and a daily. So let's say you have a correction like this, and now you get this move, and now you get this, this B wave over here. So what normally happens is, let's say this comes back down, and then we buy the trade. But what they do is they do this: they spike us out of the trade the whole time, and we never, we get so fed up with the trade that we actually miss the next impulse move. That's what happened to a lot of traders. They think this is going to go, and then it just spikes. The market just keeps spiking them out. So we discovered a way to cut that out of the equation, basically to show the brokers and the market makers a big up your side, to put it bluntly. So you get this move, let's say this is a daily, and then you get this B wave coming up. What we will do is, maybe on this, we will go and buy what they call a put option on this level, this price over here. And then we will, that's the other thing, we will buy, maybe let's expect this trade to going to be another month and a half before it comes there and then actually go up. Then we will buy it twice as long as we think, or maybe even 3 times as long as we think that it's going to come back there and reverse. Then we will buy a 3-month put option for it to reach this price. So what this actually does is, it breaks there, we buy the put. As this put option gets closer to our or level we want to buy, this put option will make you money. And quite a lot of money. So when this comes over here, we will buy right there without any stop loss. So what actually happens is the put option now becomes our stop loss. And remember, this will already, let's say, this will be already, I'm just giving an example, $600 in profit. So when it comes here, we will buy the equivalent of what we could have bought on the put option over here. Another thing about the options is it allows you to buy control a much bigger lot size than you would have without it. So now this put option is our stop loss, and we buy right there. Now this market can spike like this, we don't care. And if it spikes down, we make even more money with the put option. And then eventually when this goes up and we say, okay, they finished messing around, we will close, we can choose to close this put option and move this, put a stop loss at break even. So now we made money with this put option, and we will make money with this going down. The other beauty about this scenario is, even if we're completely wrong about it, at some point we will close the trade if it breaks this bottom, and we would have still made a shitload of money with our put option that we've got. So this is a very, very good strategy if you know how to trade options. I don't fucking believe. Okay, the last thing I want to discuss is money management, guys. And I see some traders with horrific money management. You can have the best trading method, best strategy in the world, but if your money management sucks, you are going to fail in this business. You need to have good money management. So what basically is good management? Good management is not risking 20% on one single trade, not risking 30, 40, 50% on one trade. That is how you're going to wipe your account out with very quick succession. Good money management is risking 1% per trade, or 1.5, or even 0.7. I myself, I never ever risk more than 2.5% on a single trade. Excuse me. So what I normally recommend to traders is start small, man. Start on 0.5% per trade. And then if you're successful for the month, go to 0.6. And if you get more successful, go to 0.7. More successful, 0.8. And then you can maybe go to 1. And then 1.5. So you get my drift. The better you get, you can start increasing your risk. This way, you will have a consistent equity curve that looks like this, that goes up on a consistent basis if you grab the concept and you become very good. So that's what I recommend to traders, but you can go about it as you wish. But this is what I did in the beginning, and as I got better, I increased my risk and I built my equity. Going like this. So guys, I hope you guys enjoyed the course. This is basically the end of the course now, and after this course you will be able to trade, to analyze the markets, to forecast the markets, and to trade the markets by yourself. So you are after you've done this course a few times, you will be able to be an independent trader that trades your own analysis and don't have to rely on fake forex gurus and fake traders that try and scam you. You can now just follow your own analysis. So that's it for me. My name is Stefan Tron. Goodbye.